Imagine two people standing next to each other at the same coffee shop in Dallas. They're both 30 years old. They both earn $75,000 a year. They both have exactly $25,000 sitting in their savings account. They even started their first full-time job in the same year. Now fast forward 20 years. One of them quietly builds a net worth that crosses the $1 million mark. The other still looks successful from the outside. Nice apartment, new SUV every few years, designer watch, expensive vacations posted all over social media. But behind the scenes, they're wondering why financial freedom still feels so far away. Here's the strange part. They both think they made the smarter decisions. They're both wrong. Because the biggest mistake wasn't buying the wrong thing or investing in the wrong fund. The biggest mistake was comparing themselves to everyone else instead of comparing themselves to the numbers. And by the end of this video, the gap between these two people isn't just going to surprise you. It's probably going to make you question where you actually stand. Most people have absolutely no idea how wealthy they really are compared to everyone else. They compare themselves to their neighbors, their coworkers, or the people they follow online. But those comparisons are almost always misleading. Today we're going to run the math. Same city, same salary, same age, same starting savings. The only difference is the financial choices they make over the next 20 years. Because feelings and math are two very different things. Let's meet Ethan and Noah. Both live in Dallas. Both are 30 years old. Both earn $75,000 a year before taxes. Both receive roughly 3% annual raises over time. Both begin with $25,000 in cash. Neither inherits money. Neither wins the lottery. Neither starts a business. This isn't about luck. This is about decisions. On day one, Ethan decides life is meant to be enjoyed now. He leases a brand new luxury SUV with a sticker price of $62,000. His lease payment comes to $790 per month after taxes and fees. Insurance costs another $215 every month. Fuel averages about $190 monthly. Routine maintenance isn't huge under warranty, but tires, registration, and miscellaneous expenses still average another $185 a month. Altogether, transportation costs Ethan around $1,280 every month. He tells himself something millions of people say every year. I work hard, I deserve it. And honestly, there's nothing irrational about wanting nice things. Meanwhile, Noah makes a decision that's almost impossible to brag about. He buys a reliable 5-year-old sedan for $18,000 using cash. Insurance costs him about $115 per month. Maintenance averages roughly $75 monthly. Fuel costs around $150. His total monthly transportation expense lands near $340. That's a difference of about $940 every single month. Now here's where most comparisons stop. People immediately assume Noah is simply sacrificing fun. That's not what happens. Instead of letting that $940 disappear into lifestyle spending, Noah automatically invests $900 every month into a low-cost total U.S. stock market index fund. Nothing exciting. No stock picking, no crypto predictions, no trying to beat Wall Street, just automatic investing every month. At an average long-term annual return assumption of 8%, after fees, that contribution begins quietly compounding. Nobody notices, nobody compliments him, nobody asks to take pictures with his brokerage account. That's because visible wealth and actual wealth are often completely different things. On paper, Ethan looks richer. His vehicle turns heads. His Instagram looks impressive. His coworkers assume he's doing well. On paper, Noah just looks ordinary. That's the first trap. People compare appearances. Money compares balance sheets. 1 year passes. Let's look at the numbers. Ethan has spent about $15,360 on transportation during the year. That's before parking, unexpected repairs, car washes, or traffic tickets. His lease ends exactly where every lease ends. He owns nothing. His net worth changes very little because transportation spending created almost no lasting asset. Noah, meanwhile, invested roughly $10,800 during that same year. At an assumed 8% annual return, his account finishes the year with approximately $11,250. Not life-changing, not headline-worthy, but something important has happened. His money has started working, not for him, without him. There's a difference. He earned his paycheck. His investments earned while he slept. Now, here's a statistic that's worth remembering. According to the Federal Reserve's Survey of Consumer Finances, median household net worth in the United States is dramatically lower than most people imagine, while wealth becomes heavily concentrated among higher percentiles. Many Americans appear financially comfortable, but hold relatively modest net worth once debts are included. That matters because perception is incredibly deceptive. Someone driving a $70,000 vehicle may actually have a lower net worth than someone driving a 10-year-old Honda. You simply can't tell by looking. Year 3 arrives. Ethan renews his habit. Another newer vehicle, another attractive payment, another lease agreement. Transportation costs remain close to $1,300 monthly as insurance and registration creep higher. He's now spent nearly $47,000 over 3 years just keeping a newer vehicle in his driveway. Sounds reasonable, until you subtract everything else: sales taxes, registration fees, higher insurance premiums, opportunity cost, because every dollar spent today is also a dollar that never had the chance to compound tomorrow. Meanwhile, Noah keeps investing. 3 years of $900 monthly contributions equal $32,400 deposited. With compound growth averaging 8%, his investment account reaches roughly $38,000. Notice something interesting. The investment gains are beginning to create money of their own. During the first year, almost every dollar came from Noah's contributions. By year 3, investment growth itself is becoming meaningful. That's compounding. At first, it's invisible. Then it's impossible to ignore. Now let's pause for a second because this is where almost everyone makes a critical mistake. They compare income. Income matters, but spending rate matters even more. Imagine 2 people earning exactly $75,000. One saves 5%, the other saves nearly 20%. 5 years later, they don't just have different bank accounts. They're living in completely different financial realities, and that's exactly what's happening here. Year 5 finally gives us our first real turning point. Ethan has now spent approximately $77,000 on vehicle payments, insurance, fuel, registration, and maintenance over those 5 years. He still enjoys driving. He genuinely likes the experience. And that's completely valid. But financially, his transportation spending has produced very little lasting wealth. Noah has quietly invested about $54,000 during those same 5 years. Assuming an average annual return near 8%, his portfolio has grown to roughly $67,000. Here's the number that almost nobody talks about. That $67,000 isn't just today's balance. It's an engine. If Noah never invested another dollar again, that money would still have decades to compound. That's what makes investing different from spending. One keeps asking you for more money. The other eventually starts producing money on its own. And we're only 5 years into the story. Because over the next decade, something happens that almost nobody sees coming. The gap doesn't grow steadily, it accelerates. The math starts doing more work than either Ethan or Noah ever could, and that's where the comparison stops being about income and starts becoming a lesson about how rich you really are compared to everyone else. By year 10, something fascinating happens. Not because Ethan suddenly makes a terrible decision, not because Noah discovers some secret investment, simply because time has entered the equation. Compounding doesn't grow in a straight line. It grows slowly, then faster again. That's why most people quit before the interesting part ever begins. Let's run the numbers. Ethan's income has increased with annual raises. He's now earning just under $98,000 a year. From the outside, life looks great. He's upgraded apartments. He's taking nicer vacations. His latest SUV has even more features than the last one. His monthly transportation costs have climbed to around $1,420. Insurance alone now averages about $260 per month. Fuel costs have increased. Registration fees are higher because the vehicle is worth more. Every lease signing includes acquisition fees, documentation fees, and taxes that most people barely notice because they're rolled into the monthly payment. On paper, none of those expenses seem enormous. Sounds great, until you subtract everything else. Over 10 years, Ethan has now spent approximately $165,000 just on transportation. Not investing, not buying an appreciating asset, simply paying for the ability to drive newer vehicles. Again, that's not automatically bad. Transportation provides value. Comfort has value. Safety has value. Enjoyment has value. The problem isn't spending money. The problem is pretending spending creates wealth. Now look at Noah. His salary increased at the same pace. He's earning the same $98,000. But every raise didn't immediately become lifestyle inflation. Whenever his income increased, he directed part of each raise into investments. Instead of investing $900 every month forever, he gradually increased contributions until they averaged about $1,100 per month by year 10. His total contributions now equal roughly $122,000. At an average annual return of 8%, his portfolio has grown to approximately $192,000. Think about that for a second. He didn't deposit $192,000. He deposited around $122,000. Nearly $70,000 came from growth, money earning money. While Ethan was earning a paycheck, Noah had a second employee working around the clock. His investment portfolio. Here's where the story quietly flips. Remember year 1? Everyone thought Ethan looked richer. By year 10, Noah actually is richer, not because of his salary, not because of luck, because one set of dollars disappeared forever, while the other kept multiplying. This is the flip point. It's almost invisible while it's happening, then suddenly it isn't. Now let's talk about something almost nobody includes in these comparisons. Taxes, not income taxes, investment taxes. People often hear the stock market returned about 8%. Then they immediately assume they'll lose huge amounts to taxes every single year. That's not usually how long-term investing works. If Noah invests primarily in tax-efficient index funds and avoids constantly buying and selling, he generally owes taxes only when he realizes gains by selling. Long-term capital gains are treated differently from ordinary income under current IRS rules. Again, feelings and math are very different things. Now compare that to spending. Every lease payment is made with after-tax dollars. Insurance? After-tax dollars. Fuel? After-tax dollars. Registration? After-tax dollars. The opportunity cost compounds quietly because every dollar spent can no longer compound inside an investment account. Opportunity cost is one of those expenses nobody sees, but it's often the biggest expense of all. Let's fast forward another 10 years. Year 20. This is where the numbers become uncomfortable. Ethan is now 50 years old. He's successful. His income has grown to approximately $132,000 annually. He's leased several vehicles over the years. Each one felt like a reasonable upgrade. Each monthly payment seemed manageable. Individually, none of them looked dangerous. Collectively, they changed his financial future. Over 20 years, Ethan has spent somewhere between $360,000 and $390,000 on vehicle payments, insurance, fuel, maintenance, taxes, registration, and related ownership costs. That's a huge number. But here's the part most people miss. The actual cost wasn't just $380,000. It was also everything that money could have become. Now let's revisit Noah. He's still driving practical vehicles. He's replaced them when necessary. He spent money where reliability mattered, but he never allowed transportation to consume the dollars that could build wealth. By year 20, assuming average annual returns near 8% and increasing contributions with income, Noah's investment portfolio approaches approximately $930,000. Not because he picked winning stocks, not because he timed the market, because he consistently bought productive assets, month after month, year after year, long enough for compounding to finally dominate his contributions. Here's something incredible. During the final years, Noah's portfolio often grows by more than his annual contributions. Imagine investing around $16,000 during a year, while your investments grow by $60,000 or more. That's when wealth begins accelerating. And that's exactly why patience becomes so valuable. Now, before anyone rushes to the comments saying, "So you're telling me nobody should ever buy a nice car?" Absolutely not. If I only showed you the downsides of driving expensive vehicles, I'd be doing exactly what every anti-car influencer does. Nice cars absolutely make sense in certain situations. If you're a real estate agent whose clients expect a certain professional image, a luxury vehicle could contribute to business revenue. If you're self-employed and legitimately deduct business mileage or vehicle expenses under IRS rules, the math changes. If manufacturers offer unusually favorable financing combined with incentives and you keep the vehicle for many years, ownership becomes significantly more attractive than constantly replacing it. If you simply love cars and intentionally budget for them after meeting your savings goals, that's not financial failure. That's choosing enjoyment with full awareness of the trade-off. The key difference is awareness, not deprivation. Now let's look at what nobody talks about when people brag about being wealthy. They usually mention income. Sometimes they'll mention the car, occasionally they'll mention the house. Almost never do they mention net worth. And net worth is the number that actually matters. Let's peel back the hidden layers. First, lifestyle inflation. Every time income rises, spending quietly rises too. Research consistently shows many households increase spending alongside raises, leaving savings rates surprisingly unchanged. A $10,000 raise often becomes a slightly nicer apartment, newer furniture, or more frequent dining out instead of additional investments. Second, insurance. Luxury vehicles frequently cost hundreds of dollars more each month to insure than practical alternatives. Over 20 years, that difference alone can exceed $25,000. Third, depreciation. Most new vehicles lose substantial value during their first several years of ownership. Depreciation isn't a bill you receive in the mail. It's simply value disappearing. Quietly. Fourth, financing and fees. Acquisition fees, documentation fees, dealer add-ons, title fees, registration, sales tax. Individually, they're easy to ignore. Combined, they often total several $1,000s every time someone replaces a vehicle. Finally, opportunity cost, the hidden giant. Suppose the $1,000 isn't invested this month. You didn't merely lose $1,000. You also lost every future dollar that $1,000 might have earned over the next 20 or 30 years. That's the cost almost nobody calculates. And ironically, it's usually the largest one of all. But here's something equally important. Investing isn't perfect either. Markets fall, sometimes dramatically. In 2008, broad U.S. stock markets experienced losses exceeding 30%. In 2022, markets also declined significantly before recovering later. If Noah had panicked and sold during those downturns, his long-term results would have looked very different. Investing also lacks guarantees. Returns aren't smooth. Some years produce gains, others produce losses. Liquidity can matter too. If Noah suddenly needed a large amount of cash during a market downturn, selling investments at depressed prices could permanently reduce future wealth. That's a real risk. It's one responsible investors prepare for with emergency savings. So the lesson isn't that investing always wins. The lesson is that every financial choice comes with costs. Some are visible. Most aren't. And the people who build lasting wealth aren't necessarily the ones earning the most. They're usually the ones who consistently recognize the invisible costs that everyone else ignores. In the final part, we're going to answer the biggest question of all. How rich are you compared to everyone else? Because once you compare your net worth, not your income, to real national data, the answer is far more surprising than most people ever imagine. So let's come back to the question we started with. How rich are you compared to everyone else? Most people answer that question by looking sideways. They look at the neighbor with the bigger house, the coworker with the luxury SUV, the friend posting first-class vacation photos, the entrepreneur showing off a Rolex on social media. But none of those things actually tell you whether someone is wealthy, because income isn't wealth. Spending isn't wealth. Possessions aren't wealth. Net worth is wealth. And once you compare your net worth to real-world data instead of social media, the picture changes almost instantly. According to the Federal Reserve Survey of Consumer Finances, the median household net worth in the United States is a little under $200,000. That means half of American households have less than that amount once you subtract all debts, and half have more. Now think about that. There are households earning well over $100,000 a year that still haven't reached that number because lifestyle spending consumed most of their income. There are also households earning far less that quietly crossed it years ago because they consistently invested. Income determines how fast you can build wealth. Behavior determines whether you actually do. Let's compare Ethan and Noah one last time. At age 50, Ethan earns about $132,000 a year. That's an impressive salary. Most people meeting him for the first time would probably assume he's wealthy. His car is beautiful, his clothes are expensive. He lives in a desirable neighborhood. But after 20 years of choosing higher lifestyle spending over investing, his investment accounts total only about $180,000. He has retirement savings through work, some cash in the bank, and a vehicle that's worth something. Altogether, after subtracting remaining liabilities, his realistic net worth lands somewhere around $350,000 to $450,000. That's still a meaningful accomplishment. He's far from broke. But here's the problem. His lifestyle requires almost every paycheck to continue. If the income stops, the lifestyle becomes difficult to maintain. Now look at Noah. Same salary, same raises, same starting savings. By age 50, his taxable investment portfolio alone has grown to roughly $930,000. His workplace retirement account has continued growing as well. Let's conservatively estimate another $320,000 between his 401k and employer match. His emergency fund has increased. His older vehicle still has value. Altogether, Noah's total net worth is now somewhere between $3 million and $4 million. Think about that gap. The difference isn't $50,000. It isn't even $200,000. It's approaching $1 million. Two people, same income, same city, same starting line. Completely different finish. And here's what's fascinating. Neither one ever received a massive promotion. Neither started the next billion-dollar company. Neither inherited wealth. The gap was built 1 month at a time, one automatic investment, one skipped upgrade, one decision repeated hundreds of times. That's how wealth is usually built. Not dramatically, quietly. Now let's introduce one simple change that completely rewrites Noah's future. What if, instead of investing an average of $1,100 per month, he invested just $200 more, not $2,000? Not doubling his contributions, just another $200 each month. That increases his monthly investment to approximately $1,300. Assuming the same long-term 8% annual return over 20 years, that additional contribution alone could grow to well over $115,000. That's from one small adjustment. Not because the return changed, because the contribution changed. Small levers, massive outcomes. That's one of the biggest lessons in personal finance. People obsess over finding investments that earn 15% instead of 10%. Often the easier win is simply investing another $200 every month. Now let's flip the example. Suppose Ethan made just one different decision. Instead of replacing his SUV every 3 years, he kept each vehicle for 8 years. That one habit could easily save tens of thousands of dollars in lease payments, depreciation, taxes, acquisition fees, and insurance over 2 decades. If he invested those savings instead, his ending net worth would look dramatically different. Again, behavior, not magic. This also explains why comparing yourself to celebrities or influencers is so dangerous. You don't know their balance sheet. You know their highlight reel. A person earning $500,000 with $700,000 of debt may actually have a lower net worth than someone earning $85,000 with a fully funded retirement account and no consumer debt. The expensive watch doesn't appear on the balance sheet the way investment assets do. The sports car doesn't tell you whether someone owes the bank $90,000. The vacation photos never include the credit card statement. Appearances are loud, balance sheets are quiet. Now let's make this practical. If you're wondering where to start, here's a simple framework. Step 1. Calculate your actual net worth, not your salary, not your home value by itself. Everything you own minus everything you owe. Savings, investments, retirement accounts, home equity, vehicles, minus mortgages, minus loans, minus credit card balances. Write down one honest number. Most people have never done this. Step 2. Calculate your savings rate. How much of every dollar you earn actually stays yours? If you earn $75,000 and invest $7,500 during the year, your savings rate is 10%. If you invest $15,000, it's 20%. That percentage often predicts future wealth better than income alone. Step 3. Automate everything. The FDIC reports that insured bank deposits are protected up to applicable limits, making savings accounts useful for emergency funds. Your emergency cash belongs somewhere safe and accessible. Investments are different. Set automatic monthly contributions into broadly diversified, low-cost index funds or retirement accounts that fit your personal goals. Don't wait until the end of the month. Most people never have money left over. Pay your future self first. Then spend what's left. Automation removes emotion. And emotion is usually the most expensive part of investing. There's one final point that almost never gets mentioned. The richest person in your neighborhood may not be the richest person in your neighborhood. The family driving 10-year-old vehicles while maxing out retirement accounts every year may quietly be millionaires. Meanwhile, the family with 3 luxury cars could still be financing nearly everything they own. That's why comparison is such a dangerous game. You're comparing someone else's visible spending to your invisible financial future. Those aren't the same thing. Let's go back to Ethan and Noah one last time. Ethan walked away believing he had earned the right to enjoy his money today. He wasn't wrong. Noah walked away believing consistency would eventually beat appearances. He wasn't completely right either, because if Noah had ignored emergencies, panicked during market crashes, or failed to diversify, his outcome could have looked very different. They both believed they made the smart play, but neither one actually ran the full numbers until today. And that's the lesson. The real trap isn't buying a luxury car. The real trap isn't driving an older one. The real trap is making financial decisions based on hype, headlines, advertisements, or someone else's opinion, instead of running the numbers for your own situation. Because your goals might be different, your income might be different, your priorities might be different, but the math always tells the truth. And if you're wondering what happens when someone combines disciplined investing with smart real estate, tax planning, and multiple income streams, that's a completely different conversation. One we'll break down in a future episode. Until then, ask yourself one question before making your next financial decision. Did you include everything? Because the answer that includes everything is the only answer that matters. If this video helped you see something you didn't know was there, subscribe to Wealth Blueprint and hit the notification bell. We break down the hidden math behind the financial decisions you face every day. Until next time, I'm Professor Wealth, reminding you that building wealth isn't about looking rich. It's about making the numbers work for you.